During your working years, there's only so much you can do to reduce your taxable income. But what most people don't realize is in retirement, this changes dramatically. Using the right tax secrets, you have the potential to save tens or even hundreds of thousands of dollars or more in retirement, and in today's video, I'm going to show you exactly what you need to know to do so. Hey everybody, I'm James Knoll, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. There's this misconception out there that, tax strategies exist, but it's only for business owners or only in real estate or only once you have a really significant high net worth. Well, that's true that in those instances, there's a lot of tax strategies, but what most people fail to realize is when you're in retirement, there's a tremendous amount of opportunity you have to use the right tax strategies to save a lot of money in taxes. So in today's video, I'm going to lay out to you the different options you have in front of you so you can start to understand which specific strategies might be best for you. Now, the first thing that you need to know, and this isn't a strategy per se, but it's the foundation of many of these strategies, and that's this. Your standard deduction goes up once you reach the age of 65. So if you're single and you're under the age of 65, then you have a standard deduction of $13,850. If you're married filing jointly and under the age of 65, your standard deduction is $27,700. But once one of you turns 65, each spouse, or one of you if you're single, gets an additional $1,500 added to your standard deduction. So for context, if you're single, now your new standard deduction is $15,350, and if you're married filing jointly, your standard deduction is $30,700 for 2023. Well, what's the impact of that? The impact of this is you can have more income, more adjusted gross income before you start paying taxes on it. So if you're not itemizing your taxes, these are the amounts the IRS gives you to say start with your adjusted gross income and then apply these deductions, and you're taxed on the rest. So the larger your deduction, the more you can reduce your taxable income because the more of your income that's not even subject to taxes. So like I said, while that's not a strategy itself, it trickles down and it plays into the actual strategies themselves. The first of which is tax loss harvesting and tax gain harvesting. Now, tax loss harvesting, you can take advantage of this whenever. You can be retired, you cannot be retired, but what it is if you have a security or you have an investment in a non-retirement account and it's dropped in value below the purchase price, you can sell the security. Now, you get to write off that loss that you do so with. Now, you may be saying, well, James, that's all good, but now I don't own that security. I'm sitting in cash, and when the market recovers, I don't get to participate in it. Well, what you can do is you can take the money from the security that you sold and buy a similar security. It cannot be the same one or an identical one. It has to be different, but it can be similar. What that means for you is you still participate when the market goes back up, but you've now locked in that loss that you can use in your tax return. And if you have a capital loss, you can use that to write off any capital gains you have from the sale of a property, the sale of a business, the sale of other stocks or funds, or you can use up to $3,000 of that per year to write off against ordinary income. Ordinary income is things like wages or taxes you pay on a pension or other income like that. So that's a concept of tax loss harvesting. That's very beneficial, but it's not unique to retirement. Tax gain harvesting, on the other hand, while it's not unique to retirement, it tends to be a lot more applicable in retirement because of the way your income is structured. So here's how tax gain harvesting works. Take a look at this chart right here. What you'll see is if your taxable income is under $89,250 and you're married filing jointly, then any capital gains, any long-term capital gains and qualified dividends that you receive are taxed at 0% up to that level. In other words, if managed correctly, your brokerage account that has gains from what you purchased, it could potentially be tax-free to you up to a certain level if you're doing the right things. Let's walk through an example. Let's assume that you're retired and you have a pension and you have IRA withdrawals, and combined, you're living on a little bit more than $7,000 per month. Let's assume the exact number is $84,950 per year. Now let's also assume that a couple years back, you had an extra $50,000 and you invested that in Tesla stock. And now your Tesla stock is worth $250,000. So you have your pension, your IRA over here, and whatever you pull from those or whatever you're paid from those, you pay taxes on. And as we established, you're taking $84,950 per year. And then you have this Tesla stock. And this Tesla stock, you bought it for $50,000, but now it's worth $250,000. Well, if you were to sell the entirety of that stock, that's a $200,000 gain. And that gain is being added on top of your existing pension IRA income, and you end up paying taxes on a fairly significant part of that gain. So you could do it that way, or you could use a tax code to your benefit. Here's what I mean by that. I'm going to make the assumption that you and your spouse are 65 years of age or older. Well, if your adjusted gross income is $84,950 and you apply that standard deduction that we talked about, that's now $30,700 because you're both 65 and older, what that means is your actual taxable income is $54,250. And remember, your taxable income is what we now apply to tax rates to see what do you owe in taxes. Well, let's take a look at this chart one more time. What's the federal tax rate that you pay if your taxable income is $89,250 or less on long-term capital gains? It's 0. So let's take advantage of that. You are exactly $35,000 under that limit. So what does that mean? Let's on purpose realize $35,000 worth of gains from our Tesla stock, and that's going to fill this up to the threshold. Now, given that 20% of your Tesla stock is cost basis and 80% is gains, again, $50,000 to $250,000 is what you paid for it. $200,000 of that is gains. So 20% cost basis, 80% gains. You would actually have to sell about $43,750 of stock. And in doing that, $35,000 of that would be gains. And the remaining amount would be principal. So your cost base is what you originally purchased it for. Now, here's the beautiful thing that you can do. If you want to maintain Tesla stock, you can take those proceeds and repurchase Tesla stock. Unlike tax loss harvesting, where once you sell a security, you have to wait over 30 days to repurchase it without triggering a wash rule, there's no such rule for tax gain harvesting. So if your income's under these thresholds, you can sell percentages of your stock, and what you're doing is you're continuing to increase the cost basis so that future sales you won't owe as much taxes on, and in doing so, you're not paying anything in federal taxes. Now, depending on what state you live in, there may or may not be tax consequences for this, but at least at the federal level, this is what's called tax gain harvesting. Now, quick side comment on this. People typically don't know this exists, and they're very excited when they find out that it does. Then they'll ask the question. They'll say, hey, James, what about in that example where you sold $35,000 of Tesla stock or $35,000 of gains? What if you accidentally realized $36,000 of gains? Does that blow the whole thing up? Well, no. $35,000 of those gains is still tax-free at the federal level. $1,000 of those gains is now subject to a 15% federal tax bracket. And on top of this, this does not raise the taxable income that your pension and your IRA are subject to. Those are subject to ordinary income tax brackets, while what we're talking about here is capital gain tax brackets. So that's the beautiful thing about this is yes, you want to be as precise as possible, but if you're a little bit off, as most of the time you're going to be when it comes to selling different securities, it's not going to make the whole thing null and void. It's just going to have the excess amount above that threshold that's now taxable. And hey, real quick, if you're enjoying this video and learning new things that you didn't know before, make sure that you subscribe and like this video so you get more great content like this in the future. And with that, let's go to the next strategy. The next strategy is what I like to think of as tax arbitrage. Now, what arbitrage is, it's a simultaneous purchase and sale of the same investment, but in different markets to lock in a guaranteed gain. For example, what if on one market I could buy Apple stock for $100 per share, but then on some international market, I could sell it at $102 per share? Well, what I would do is I would simultaneously buy as much Apple stock here as I could for $100 per share and simultaneously sell it at $102 a share, locking in a guaranteed return. Now, that simple of an example does not exist in real life. There are arbitrage opportunities, but not to that extent that I just talked about. However, that principle can be applied to our tax situation. Here's a very real version of that and how it happens in real life. You can choose what tax rate you want your IRA distributions to be subject to, and this comes in the form of a Roth conversion. If you run your financial projections and you see that once you reach required distribution age, between your required distributions from your IRA, between Social Security, between dividends and interest, between any other income you might have, you might be pushed up into a pretty high tax bracket. That tax bracket might be 24, 28%, depending on what it will be in the future, versus today, you might find yourself in the 10% or the 12% marginal tax bracket. So this is where the concept of arbitrage exists. Can I intentionally do something at a lower tax bracket to avoid having to do so at a higher tax bracket? So that's what Roth conversions are. Can you be real smart and intentional about when you're paying your taxes? Now, this does require that you pay more in taxes up front sometimes than you otherwise would have, But the savings can be profound. The savings can be tens or hundreds of thousands of dollars or more, depending upon your IRA composition and your financial plan in general. Another tax strategy exists for those that are charitably inclined. Now, here's why charitable giving becomes so much more important to have a tax strategy around in retirement. I mentioned the concept of a standard deduction. Let's assume that you're married, filing jointly, and you're 65 or older. Your standard deduction is $30,700. Well, if you're retired, and let's assume that you have a paid-for home, you go to file your taxes. Now, in general, there's definitely more deductions than just this, but in general, the things that you're going to deduct are mortgage interest, any charitable giving you do, state and local taxes, but capped at $10,000, and medical expenses in excess of a percentage of your adjusted gross income. Let's assume you don't deduct medical expenses, and let's assume that you have no mortgage interest because your home is paid for. Well, you can only deduct a maximum of $10,000 in state and local taxes. So property taxes, state taxes, whatever that might be. So maybe you're doing a pretty significant amount of charitable giving. Let's assume $15,000 per year. Well, if I look at all your deductions, there's nothing in mortgage interest, there's no medical expenses we're deducting, there's $10,000 that you can deduct in state taxes, and then there's $15,000 of charitable giving. Well, that's $25,000 total. But your standard deduction is $30,700. So given the option of deducting $25,000 or $30,700, you're going to choose $30,700 every single time. Now, if we take a simplistic projection of that and assume things stay the same for the next 10 years, you will have given $150,000 to charity and gotten zero tax break for it. Now, of course, you're not giving for the tax benefit, but if giving is something that you're already doing, how can we get a tax benefit for that? Well, we do that by asking this question. We say, is there a way to take all the giving we're going to do over the next 10, 15, 20 plus years and bring that all into one single year? So for example, if instead of giving $15,000 per year for 10 years, can we find a way to give $150,000 all in this year? Now, maybe we don't want to actually give the entirety of that $150,000 to the charity or church or organization that we're giving it to, but what we can do is open a donor-advised fund. So you open a donor-advised fund, you transfer $150,000 into it, and that gives you a significant tax deduction today. Now talk to your financial advisor and your tax preparer because there are limits on how much you can deduct based upon your adjusted gross income. But what you've done is you've taken all those years of giving and taken one big deduction this year, and you still retain full control of those assets. Now it's an irrevocable gift, so you can't take them back and spend them. But now what you do is each year going forward, you do your $15,000 gifts from your giving fund as opposed to from your cash flow. So this concept allows you to take one significant deduction in the year that you make the contribution, as opposed to spreading those contributions out over time, which consistently keeps you under the standard deduction threshold, which essentially means you don't actually get to deduct any of it. So a lot more planning points along that, but that's a good overview of how donor-advised funds work. Now, on top of this, you have something called a qualified charitable distribution. Once you reach age 70 and a half, you can do your giving directly from your IRA. So instead of having to pull money out from your IRA, pay taxes on it, then it goes to your bank account, then you gift the rest to a charity, well, what you do is you do your giving right from your IRA to a charity. Now, you can do up to $100,000 per year from your IRA, and that will be adjusted for inflation going forward. But the beautiful thing is this counts against what your required minimum distribution would have been. So if you're 75, let's say, and your required minimum distribution is $40,000 per year, and you want to give $15,000 to charity, well, give that $15,000 right from your IRA to the charity, and then the remaining amount, the $25,000, that's now what you're on the hook to have to take out. So it's a lesser amount that you have to take and pay taxes on because you did your giving directly from the IRA. And the last thing that I want to cover today is Social Security. Now, Social Security is not a tax strategy, so I don't want to make it sound as such. However, the way Social Security is taxed is more tax favored than other types of income. So at most, 85% of your Social Security benefit is included in your taxable income for federal taxes. So what that essentially means is 15% or more of your Social Security benefit is tax-free at the federal level. Now, most states, they tax Social Security favorably as well. I'm in California. California has one of the highest tax brackets in all the country, but Social Security is tax-free. Many other states are the same. So when you have Social Security, when you're looking at how do I construct my financial plan, do I want one more dollar in Social Security or do I want one more dollar in IRA income? Well, they may seem like the same thing, but that $1 extra in Social Security is worth more to you because it's going to be taxed less. So as you're constructing your plan, understand the nuances of how different types of income sources or assets are taxed so that you can construct the most tax efficient plan for yourself in terms of creating the most income after taxes. So all of these things, including Social Security, are important aspects to know to how can you keep your tax bill as low as possible in retirement. Now, if you're hearing this and saying, hey, that Social Security thing, that's real interesting. I'd like to make sure I'm making the most of it. Well, I made a video to teach you how. So check out this video here, where I walk you through 4 simple things you can do to increase your Social Security benefit. Once again, I'm James Knoll, founder of Root Financial. And if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.